Everybody, my name is Josh Rajan. I am with Lincoln Financial Group. So today, I want to first and foremost thank everybody for taking the time out to join us. I know we're going to cover a lot of things within the FIA space, and I hope the most you get out of this right now. We're going to share some pieces in regards to using FIAs, how FIAs work, and really where they can make a difference in your practice. But I also wanted to open it up at the end for questions, right? Because I can only prepare you as well as the questions I answer for you. So once I kind of go through what the successes we're seeing, how we're setting you up for success when you're looking at Lincoln and FIAs, then I'll just kind of open it up for questions. So this way, I want you to be confident when you're presenting this to a client or looking at this as an alternative to a client. So that's pretty much the game plan for the day. So right now, what I want to mention is, hey, first and foremost, working with Lincoln, you have access to myself and my external partner, Tim, who could not be here, but you get that by working with CAFL and our partnership with CAFL. So I also want to thank CAFL for setting everything up today and having this meeting. And really, what I'm going to start off with is how Lincoln and FIAs are really going to set you up for success. And SET in this case is going to stand for the simplicity of the FIA, how it enhances conversation and enhances your planning with the solutions we have available, and the simplicity of those solutions, as well as the dedicated team you have here so you're not by yourself when you're looking through this. What I'll do is I usually hate starting with a rate sheet, but I feel like it's going to be useful because this is probably something you're going to look at often, and I want to make sure we show you where the simplicity is when you're looking at this. So let me open this up here. Can everybody see my screen? No, not yet. How about now?
Yes.
Perfect. So when it comes to the FIA space, we have our flagship product, which is the OptiBlend. Okay, it comes in 3 simple surrender charge periods. We have a 5-year, a 7-year, and a 10-year. And then there's 2 different bands for the rates you're going to get. We have a low band of less than 100K and a high band of over 100K. And that's really going to be the simplicity of, hey, it's not overcomplicating it. It's just 3 simple surrender periods, 5, 7, and 10. They all offer 100% downside protection. So if you're looking at MIGAs, especially when clients nowadays are trying to combat CDs and trying to find better rates, we offer MIGAs as well. Right now, our high band on the 5 years at 5.1, so still over that 5%. But where we're really finding success with agents is pivoting some of those MIGA conversations over to the indexed annuities. And I'm not saying it's going to be successful all the time, but if you can leverage 20% of your conversations and put it into an FIA, it does 2 things, right? First and foremost, it offers some better upside potential for the client to get better gains. Secondly, when it comes to you and your practice, it's almost double the revenue that you get from writing a MIGA. And if you have 2 great companies you're presenting, one for a MIGA and one for a pivot, you're really making sure you do the Reg BI, right? You're doing the best interest, but you're really allowing yourself the opportunity to grow your practice by doing it as well. So when it comes to the
sure. You got to let us know if this is New York or non-New York when you show us this stuff.
So none of our products except for the SPIA are approved in New York right now. So there are updates coming at the end of this year. We will definitely get around to you guys for sure. I know a lot of y'all right in New York. So when we get to that point, most likely by the end of this year, you'll probably start seeing more New York products across the industry just because New York is loosening up a little bit and trying to get traction again. But right now, all these products are approved in all states but New York. Okay? Awesome. So I know when you first look at this, you're kind of like lost in the sauce, right? There's all these different crediting strategies. There's a lot of different numbers on here. But the simplicity with Lincoln, first off, comes from the indexes we have. If you notice, the majority of our index choices are with the S&P 500. Right? So not only is it something that everyone knows about or has heard about, but it has real historical figures. So many times you're looking at indexes that have no history, back testing, looks really good when you're presenting it, right? Because the numbers look great. But then when the annual review time comes around, it's like, what just happened? I thought this was going to do fairly better than it did. So we primarily focus on the simplicity with not just the S&P 500 as a majority of the indexes, but also with our performance triggered strategy. So let me kind of back into this in a way where you're probably used to understanding it, right? When you're looking at most of these index annuities, everyone's familiar with the cap rate, right? Where, hey, whatever the index does, you get up to that cap rate and you won't exceed it. So if the index does 10%, you get the 9.5 in this hypothetical right here. If the index is 3, you only get 3. The difference is we said, how can we simplify this conversation so when you're talking to clients, you can set expectations accordingly. And that's what happens with our performance triggered strategy. And all the strategy means is as long as the index is flat or positive, the client gets the 8.5%. So you no longer have to worry about, oh, well, let me explain this to you. If it does this, you're only getting this. Or if it does 3%, I know we said 9.5. Your annual review meeting is, hey, the index was flat or the index was positive or the index was negative. If it was negative, you're a 0, right? It has 100% downside protection. You're that hero for that year. But if it's flat or positive, even a penny, you would get that full 8.5% rate. Okay, and one of the stories that happens with Lincoln, especially because we're on that penny, is if the index is flat or positive or up a penny, right, you get the rate. So you can't lose a penny, won't cost you a penny, and if the market's even up a penny on the S&P 500, you get that full 8.5% trigger rate. So I'll repeat that one more time. It doesn't cost you a penny, can't lose a penny, and as long as the market is up even a fraction of a penny, you get that full 8.5% trigger rate. So imagine that when it comes to those belly-to-belly conversations and annual reviews, right? There's no more saying, hey, the market did this and that's what you're getting, or hey, this is how we're doing the math to figure out what you're going to get. It's as simple as, well, it was flat or positive, we got this, and you're good to go. So that's how it's going to simplify those conversations for you. And then when we're pivoting to looking at the enhancements and how does this enhance your portfolio, a lot of the times we're looking at this as a fixed income alternative or as a bond portfolio alternative, right? Just a sliver of that to come off of there. And with the MYGAs, great, you're getting the 4 or 5, but what impact would it have on your strategy if your clients were getting 7 to 10% returns? I'm sure the likelihood of success, especially if you're using any programs, would increase exponentially there. So when you're looking at MYGAs and you're saying, well, Josh, the trigger's great, the history is great, 8.5% is great, but how do I put this in front of a client when I'm presenting this MYGA? One of the key facts that works out here is, first off, we have this piece on the trigger, and most clients, from what I've seen in a lot of the meetings we've had, is they want to see that that's guaranteed, right? And our marketing pieces are all approved for client use for the general public, so it literally has in there guaranteed. And that's rare that you see that on flyers nowadays, right? So not only are you speaking to it, you're showing them an approved piece that also says, hey, yes, this is a guarantee as long as it's flat or positive. The other portion of this is, we talked about historicals and the S&P 500 having real history. Well, over the last 20 years, we did rolling monthly periods, and 79% of the time, the S&P was positive. So when clients talk about, hey, I think there's too much volatility, I'm not sure I want to take that jump in. Well, in the last 20 years, almost 4 out of every 5 years, if the S&P was positive, you have the downside protection here, but you could also be maximizing that money. All right? And to build on that, we have this piece which I like, which is used often to combat the MYGA conversation. So this is a piece that shows how, hey, we can use a par rate and a trigger. For those of you who are not familiar with the par, a par rate just means you get this percentage of the return that the index does. Okay, so for instance, on our rate sheet, our par rate is 62%. So if the index did 10%, I get 62% of that, so I would have gotten 6.2. Okay. Now, when we go back to this and look at it, we said, hey, let's put 50% of that performance trigger we just covered, where if it's flat or positive, and 50% in that par rate, where you get a percentage of the full return from the index. And here's how it's done since 2008. From 2008 to 2003, it's had an average rate of return of 6.7%. Majority of the MYGAs you're seeing around 5, maybe slightly higher than 5%. So that's what we did. We compared this allocation strategy to a MYGA at a 5% rate of return. And we said, hey, here's how consistently it's outperformed it over a 10-year period or over a 14-year period. So this is a lot of the pieces you'll see is a lot of historicals, a lot of numbers, a lot of the reasons that we've put into there as to why now is a great time to get into the market and get into an FIA, especially with the volatility that's happening and having that protection there. Is there any questions there? I'll
Yes.
pause for a minute. Sure, Robert.
I was doing fine until you this last part.
Okay.
What is credited? The participation rate or the trigger?
Great question. On this one, it's a split allocation, meaning you can actually put an allocation between different buckets, right?
Thank you.
So we split this bucket
two
between two of them.
allocations. I got it. Thank you.
Exactly. But that's a great point you bring up, because this is the flexibility it gives you, right? You're not locked into just one bucket. So in a year from now, if you're saying, hey, this rate looks good, but I like this rate better, on anniversary every year, you can change between the allocations. And that's a big deal, especially when it comes to looking at certain strategies that are outperforming others and being able to pivot. So this way, when you're looking at annual reviews, you give that perception of, hey, I'm actively managing it, but you're actively managing that portfolio with simple solutions. So thank you for that question there. Okay. So the other parts of this is we also have another index called the daily risk control 10%. And I'm sure the second I said risk control, almost half the people on here were just like, do not even start talking to me about risk control. I don't want to hear about risk control. I've been burned enough by risk control. But the reality of this index is it has real history. So a lot of these historical, returns on some of these proprietary indexes that had risk control were all back tested, right? And they look great. We said we don't want to do that. We want to go into an index that has real returns. Let's look at what's really happened and base our crediting strategies on real returns. So our daily risk control 10% offers a 10.55% trigger. So just like our regular trigger rate, hey, if this index is flat or positive, the client gets 10.55, which, hey, you're almost getting 2% more than what the regular S&P 500 is giving you, right? And that's usually what piques your interest at first. Then it's like, well, what's the consistency? How do I know I can trust this index? Great question. What we did is we compared the S&P 500 to this 10% daily risk control index, and we looked back from 2014. And we said, how many years was the S&P positive? How many years was this 10% daily risk control index positive? And if you can see, there's a stark correlation between the amount of positive and negative years between those two indexes. So if I have this history of having positive and negative returns so highly correlating to the S&P 500, why wouldn't I choose an index that could potentially get me 2% more? And remember, you can always split it between them, right? I can do 50-50 between the regular trigger and the 10%. And I could still average out around 9.5%. So back in probably 2015, 2018, even through the early 2020s, you were seeing rates around 3, 4, 5%. And it used to be like, hey, FIAs are only going to get you 4 to 6. We're now in this high interest rate environment where it's the time to take advantage of this index and these strategies and these rates. Because in this environment, we're able to get you 7 to potentially 10% returns on some of these allocations and indexes. So why wouldn't I take advantage of that, pivot over, get an extra 3 to 4 or 5% more a year, which is compounding, and improve that client outcome with not only the better strategies and the better rates, but the compounding effect, right? And one thing I will add here too is with the FIAs, remember, the other opportunity here is with our FIAs, you can add money each year. So if you have a client with a Roth IRA and you want to give some higher upside to there, but also add contributions every year, we allow up to $25,000 each year. So we see a lot of agents that are saying, hey, look, it's sitting in a Roth IRA at a bank or in a brokerage account. We want some more protection from volatility. Or it's sitting in a money market somewhere, and we want some more growth without losing money. And we want to also be able to add contributions. And our FIAs allow for that. So with all the flexibility we have in there with the crediting strategies, the surrender charge schedules, the additional premiums, it allows for you to really have that belly-to-belly conversation on an annual basis and not only say, hey, here's what we returned, it's where are the other assets that we could bring over? Because we know every conversation is not just about what's your money doing that's with me right now. It's where else are you locating money at that we could potentially bring over and expand this relationship with. So that is really where we're seeing success, is using these strategies. The last piece I'll give is because, Robert, I heard the TV in the background, so I had to make sure to include this piece since we were talking about market updates, right? So what we did was, with the amount of funds that are in bonds or on the sidelines, we said, hey, let's track a larger bond aggregate fund and see how it's compared to some of our blended strategies. So we looked at the Barclays U.S. Aggregate Bond Index, which has the highest, bond percentages in there, and we looked at that and compared it to a strategy with a hybrid allocation, right? So we split it between a couple of different models. But I put this here because I don't want you to have to say, hey, what's the best strategy for me? I'll rather give you 3 or 4 that have pieces to go along with it and then have that conversation with you one-on-one. So right here, we can see using this, 4-way strategy, the Barclays only was up around 119,000 after starting at 100,000 back in 2013. But using that blended strategy on our indexed annuity, it was at 182,000 at the end of the 10 years after starting at 100,000. And part of that is, look at the downswings. That protection from those negative years really adds to the likelihood of overachieving at the end of it, right? If we can take out the down years, but then start at a lower level every time a new anniversary starts, it gives us higher potential for those new years that are starting. So why not get in, right? And sometimes I'll see it where it's a 0-year, markets are down, and agents are like, look, I want to put 25K in. If it was down last year, higher likelihood that I'll get some better returns this year, right? And also, to answer a question that might be out there, adding new money does not extend the surrender charge period. So unlike VAs where, hey, I add new money in, now it's an additional surrender charge period. If you add money in the 3rd year and it's a 7-year product, you're still only in there for 7 years. You're not extending out that surrender charge schedule. And lastly, here's the thing, right? It's a team effort. So when you submit business to Lincoln, first off, you have Kathleen and Kelly, which are awesome. You have Tim and myself, and then you have a dedicated case coordinator. So you're not calling into a 1-800 number to find statuses. You're not calling a 800 number to resolve issues. You're talking to a live person that's dedicated to you, that's going to follow through the whole process and keep you updated with where everything's at, which is a big difference than what you're seeing right now in the industry as a whole, where it's just a lot of automation happening. And don't be afraid to get us on the line with you. Like, there's been multiple conversations with clients where we have Tim or myself on the line, and we help seal that deal, right? Because they might want to hear from the insurance company itself because it might be too good to be true. And what we say is it too good to be true, or is it too good to be free, right? Because that's the main thing. It's like, how am I not paying anything and getting these returns? And my answer back to them is, it's too good to be free, which is why there's only limited access, meaning they have 10% free withdrawal starting year 1. Other than that, there's no limitations on here, right? I could take money out starting year 1 with 10%, but that's the only drawback is that I have less liquidity than I would have. But it's a heck of a lot more liquidity than putting in a CD and having to break that CD open, right? And when you're looking at it, how many clients are really taking more than 10% on an annual amount? If they are, then we kind of need to reassess the plan overall, right? I know we have some of them where we put them in, and next year it's like, I need to take half out. And we're like, we had this conversation last year about this 5-year plan. We're only 2 years in. What's going on? So that's really where we come into play. And I wanted to really review these main things because I feel like the simplicity is what's going to sell here. It's what's going to make the conversations easier, and it's really what's going to engage your clients. And that's really what I wanted to review, but I wanted to mainly open it up for questions. I want to be able to give you the tools and answers you need to have better conversations with clients. So feel free to shoot away.
I have a question as to 2 underwriting questions. One,
Okay.
what is the limit of the total liquid assets that you will accept?
Okay. Great question. So we're actually pretty flexible with that, right? Typically up to 70%, we're fine. So as long as there's annuities account for 70% or less of the total net worth, we're usually fine with accepting it. As far as liquid net worth, we just want to make sure they at least have 3 years worth of emergency savings on hand.
You know that's extremely liberal compared to the competition. Most of the competition is 25 or 35% of liquid assets.
Right, but that's what it would be, because if the majority of the funds are in annuities, then up to 70%, that leaves 30% that could be liquid, right? Or even if it's 20% liquid, we would still accept it. We just need a pre-suitability guideline or a letter of instruction.
No. I'm sorry. I didn't make myself clear. They will limit the amount that can go into the annuity to 25 or 30% of total assets.
Gotcha. Yeah, we allow up to 70%. So
Set this okay, you covered the withdrawal.
yeah.
Oh, New York. My client lives in New York. His business is in New York, and they come to Florida to see me, and we write the application in Florida. Yes or no?
So if it was last year, I would have said yes. Since it's this year, what's happened is, just to give you a little background before I answer the question there, is New York started auditing the amount of cross-border sales that were happening this year. So last year, I would have said, hey, look, as long as they do business with you on a consistent basis, no problem, we'll accept that cross-border sale. But because of the amount of audits that are happening in New York this year, there's two reasons we will allow for that. If they have a second residence there, or if they have a residence in Florida, or if they work in Florida. Anything other than that, we would have to pass through pre-suitability. But it's something that's just happened this year with the amount of audits that New York has started doing on cross-border sales, and it's part of the reason they're also starting to get some more leeway in getting back into New York as an insurance company.
Thank you.
Anytime, Robert. Thanks for the question. I appreciate that. Yeah, and one thing I'll add too is, just in case you're seeing it right now, because it is coming up for me more and more, anybody have any death claims, like non-qualified Benny accounts or IRA Benny accounts, and they can't really find a home for them because most carriers aren't accepting them? Yeah. Well, what I'll put out there is this, right? On non-qualified Benny accounts, we accept them. We just need to start distributions within 1 year of death. So if you have somebody who's passed away and their beneficiary is meeting with you and they're trying to look for an option for a Benny non-qualified, we will take those on the 5, 7, or 10-year version. They just have to take the required distribution starting within 1 year of date of death. And then if it's an IRA Benny account, as long as it's spousal or an exception to the Secure Act, we'll take those. It's a little bit more limited because of the Secure Act, but the non-qualified Bennies, easy way to kind of extend out that time frame that they can withdraw from it, give accumulation. And I've seen it before too, where they keep taking the withdrawals out, but the returns kind of match up, and at the end they still have some sort of legacy left over. So that's another portion I want to put out there, just in case it does come up.
Thanks, Josh. Oh, I thought maybe we had a question. I guess not. No, thanks for hopping on today. This was amazing. So this is actually in a series for all the advisors that are on here on fixed index annuities. The next one we're actually going to have is July 11th at 11 a.m. So 7-Eleven at 11. And it's around what is available in New York. Robert, I know you had some questions around that, so we'll review that next time. But Josh, thanks so much for hopping on. This was amazing. And we'll be sure, if we have any questions after, please feel free to send them over to your CAFL team, and we'll be sure to get them over to Josh and get those answers for you.
Please tell Greg to let me know what the commission is.
Okay. Greg's on here. He'll give you a call.
I know. That's why I asked.
Kelly, what I'll do is
I'll give it a call.
And Kelly, I'll send you all the pieces after the meeting to send to the team. And I'll also send you that website, because there is a website we have where you can check out all our marketing. There are pieces that are not product specific, talking about cash conundrum, sitting on the sidelines, and that's all no login required. So no need to remember another username and password. It's there for you without a login.
Perfect. Thanks so much, Josh. Thanks everyone for your time.
Thank you.
Have a great day.
Thank you.
Take care.
Thanks, everyone. Have a good one.
Bye.